The top performing smart beta ETFs are those focused on higher quality stocks. But the same story isn't holding true for bonds. Here to tell us more is Psarofagis of Bloomberg Intelligence. Tom, let's break this down. When we say that it's not the same for stocks and bonds, what do you mean exactly?
Sure. So let's break down what quality means, right? So when we look at all the different factors, quality tends to get overshadowed by value, momentum. But performance-wise, quality is doing the best this year in equities. So what quality means is companies with cleaner balance sheets, less leverage, better cash flow, they're doing really well. Now, let's apply those same factors to fixed income. So let's look at companies that are better able to service their debt. That's actually, we're seeing a divergence, meaning that quality stocks are outperforming, but quality bonds are underperforming. So one market is saying risk on, the other one's saying risk off. Typically, they tend to move in tandem. So I think this divergence in factor performance is actually pretty interesting between the two different asset classes.
Tom, I would think with high yield spreads widening last quarter, investors would be flocking to more defensive bonds. Kind of walk us through what you're seeing.
Sure, and we tend to see this a lot with a lot of the factor products, that you need an event to happen. So the market goes down, then everyone all of a sudden loves low vol, and everyone flocks to low vol. So we saw this when spreads widened late quarter last year, and then in 2015. So when spreads widen, but everyone always tends to go in after the fact. It's sort of like buying insurance after the floods already come. They tend to flock into these products after, spreads then come back down, and they tend to flock back out. So there's a lot of performance chasing with these factor products.
Why do you think these quality bond ETFs haven't really caught on?
Sure. So when you think about when spreads are widening, right, in high yield, at that point, do you even want high yield at all? So we tend to find that that decision tends to be more binary, that I'm not going from risky high yield to less risky high yield. When spreads widen, I'm just out of high yield. So I'm using like a bigger ETF, trading in and out of it. I think, and also these products tend to be a little bit newer. I think we need to see longer track records, but at least it seems for right now, people just like to trade in and out of high yield.